welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Philip Silverman, who is a managing director at Kingsview Management. Philip, thanks very much for coming on the show.
Thanks for having me.
So a little bit of a choppy, rough outlook now. We have weakness in equity markets pretty much across the globe. Commodity markets following equity markets down. There's pressure definitely there, with the exception of some areas. Grains recently, weather-related, you know, the intense heat wave that we've been having here in the U.S. What's your outlook?
My outlook is for the slow growth to continue. And as investors recognize that growth is slowing, earnings are going to be weaker, I would foresee the stock market to be coming down. And with growth slowing, I would expect...
How far down?
Tough to say. I definitely think we could get to a point where we give back all the gains for the year and be down a few percent. You know, we could see the S&P down in the 1,000 area. I don't necessarily put a target on it. I'm looking more for the direction. So we're seeing the economy slowing. ISM's dip below 50, the PMI is weak, unemployment staying high, can't really seem to get that down. So all of these things, and the bond market is obviously pricing in basically a recession. And the only bull case I can see is more central bank action, which, as we had discussed earlier, that just, you know, they do something and it has less and less effect. You know, the European move from a couple weeks ago has already been given all the way back. So I think the push and pull between slow growth and central bank stimulus is what we're seeing now, and I think slow growth is going to win out.
All right, so I'm going to try to play the devil's advocate a little bit here. I mean, you know, we've seen high unemployment now for 3 years, okay? And we've seen growth well below trend for 3 years. I mean, you know, a 2% GDP growth rate, or even a 1.8%, 1.5% GDP growth rate wasn't necessarily bad for stocks. For one reason is inflation still remains tame. Labor costs are way down for that very reason, that we have such a large pool of unemployed. And firms are able to still manage to eke out a profit in this environment. So, I mean, you know, to look and say that the market is going lower when, in fact, we've been dealing with these conditions for a while now, and the market has doubled off its bottom, its 2009 bottom. You know, we have some hesitation now. But look, low interest rates are also starting to help. I think we're seeing some improvement actually in the housing market of all places. For the first time in like 3 years, we're starting to see some stability in home prices. Home inventories have come down significantly, and housing is a very important sector to most, you know, people, because that's where their net worth is. So that would be my devil's advocate opposite argument to that. And in the case where, let's say we stay at around 2% growth, doesn't that mean commodities bottom somewhere down here?
If we stay at 2% growth, then my thesis would definitely be wrong. I think commodities are getting more attractive given that scenario. However, you look back at this rally we've seen since 2009, the markets have doubled. So that's a big move. I think that 2% growth down there means a lot more than 2% growth up here. Now, we've been seeing revisions in GDP down into the ones recently, and I think there's a good chance that in the next couple quarters, if we're not in a recession now, that we will be in one. You know, we've had an expansion for the last 3 years. If you were to take away the rallies of the 80s and 90s when you had fueled by high asset prices by the Fed, and you were to say maybe a bull market lasts for 3-4 years and a bear market is going to come in for a year and a half, I think that's a pattern we're going to be seeing probably for the rest of the decade. And that would coincide with my idea that you're on a super cycle for commodities and you're on the reverse for equities. 80s through 90s was equities, now we're commodities. Furthermore,
how could that be? How could those things coexist? Because if equities are going down, I mean, it would mean, I presume, a reflection of weak economic growth globally. So how can you support higher commodity prices if you're having global economic weakness? I mean, it just seems hard to justify that position.
It does when you first think about it, but this is a cycle that we've seen many times throughout the last century. So you had, if you go back before the 80s and 90s, then you see the 60s and 70s. The same thing where commodities were high, stocks were low. As the commodities ultimately come down, stocks go up. So it's kind of like when commodities are high and stocks are low, as the commodities come down, costs are going down and the stocks have an ability to go up, and vice versa. And we're there now. Now, one thing interesting to note is that profit margins for corporations, typically for S&P 500 is what I'll use, are at, say, 30 to 40% above their long-term historic mean. And we've got a situation where that's a mean reverting series. So we would be looking for those to come down. If those come down, as they always have in the past, and of course a lot of people may say this time is different, that would be putting pressure on company earnings. Now, if you were to adjust for profit margins in your PE ratio, they don't look nearly as rosy as many analysts are looking at right now. If you take if your model has high profit margins and you're projecting that out forward looking, you're going to get a much better growth trajectory than you're potentially seeing.
So you're saying the stock market is still fundamentally overvalued?
Yeah, I would say the stock market
based on those metrics,
based on profit margins, based on growth slowing, and I think that I'm not necessarily calling for a 2008 kind of crash or anything, but I believe that over time, as the market works its way sideways and down, we're going to get to a point where price is coming down a bit, time is moving further, and then we're going to see an opportunity where we've worked off a lot of excesses and we could get moving forward.
All right, so now what about, all right, so stock markets have been weak, the data, the jobs data has been weak. What are the probabilities for another round of quantitative easing by the Fed? Everyone seems to be waiting for that to happen.
It seems to be, the notes from the Fed meeting yesterday suggested that a couple of people were starting to say they're going to need to do it, and a couple more are thinking along those lines as well. It's tough to say. I mean,
well, doesn't the Fed have a dual mandate? I mean, they have the inflation mandate, so that's pretty much under control. But they have an employment mandate as well. I mean, don't you think they're looking at that and saying,
I think it's tough because, Bernanke is going to realize that what he's doing now is having less and less effect on the markets than it did at QE1.
Why do you think that's true?
Why do I think that's true? Because what he's doing, interest rates are already low. There's already plenty of money in the system. We don't need more. That's not constraining what's happening. We don't have demand. There's tons of cash on balance sheets. Corporations have huge amount of cash. People don't even know what to do with their cash. That's why we see treasuries down, yielding. What did they? The auction went off at 149 yesterday in the 10-year, a historic low yield.
So there's
there's no fix for the Fed.
There's no demand because consumers don't have the money. There might be a lot of money in the system, but it's concentrated in places that are not leading to demand. It's a policy shift, and that's going to gotta come from fiscal. And you're facing potentially the fiscal cliff, which is the end of the Bush tax cuts. Taxes going up. And huge spending cuts next year. Our own version of Europe being done right here.
And from here through November, I expect absolutely nothing to get done. And then you're going to actually after November, there's going to be a big change. We don't know what's going to happen depending on who wins, but there's going to be this continued fighting between the Democrats and the Republicans when they need to get together.
But I think they will. This is all political, and it seems to me like even the most strident deficit hawks at the end of the day understand that it's just sheer lunacy to allow us to go over the edge of the fiscal cliff, and they're going to do it like they do with everything else. They're going to take it right to the end and then come up with a way to resolve it. Don't you think?
Well, I certainly think they'll resolve the debt ceiling and the fiscal cliff, but whether they'll actually do what they need to really do to get our economy going again, which I don't necessarily think is that outrageous. I think for a reasonable person, which I believe I am, and it sounds like you are, we could get that done. When you put in these extremists, the Tea Party on one side, the far left on the other, you've got a small group of people holding our country hostage right now. And we need to get back to where we were, where we're making deals and getting things done. Because you can't think about it if you were to do this. If you were to get rid of some of the tax loopholes, broaden the base. And then you have the government come in and say they're going to give, the only tax credits they're going to give are for companies hiring workers. So you hire someone, you get a tax credit. So now you have these companies that have...
Yeah, but see, this whole thing of giving incentives to companies to hire, it doesn't address demand. You can hire 1 million people, okay? You could give credits to hire 1 million people. If nobody comes in and buys your product, 3 weeks from now, you're going to be laying them all off anyway.
True.
You got to give them money. Here's what I say. Suspend the payroll tax, a payroll tax cut.
Agreed.
So people get to keep, that's like $1 trillion taken out of personal income every year.
Yeah.
People get to keep more of their money. They're able to go out and pay their mortgages, pay their rents, buy groceries, do the things, spend on the things they need to spend on. The demand problem goes away. Anyway, what now is your best, trading position?
Our best trading position is we are net short the S&P. And we do our positions through the use of options. So right now we are short call spreads on the S&P 500. And we've actually pulling back the last few days since we've seen 5 days down in a row. I would expect to see some sort of a bounce here. But net, our view is that it's going to be a very rough summer. And there's going to be volatility, which is going to lead for good opportunities for those people that can manage their risk and be fairly nimble. The other thing is we're looking for commodities to come down a bit more, in which case we will get bullish on commodities. I'd like to see oil come back into the 60s, which I think would not only be great.
Be great for gas prices.
It would be great for the economy.
Yeah.
It would be.
It's already
excellent.
Good that they're below 100. Anyway.
Absolutely.
Good outlook. So we'll be waiting for an opportunity to move in on some weakness when it comes. Thanks very much. All right, folks, that's it for now. This is Mike Norman saying see you next time. Bye-bye.